Welcome back. You're watching Metropole Television. My name is Simba Elijah Charles Kiaga. This is your economic review. Let me introduce the guests who are joining us this morning before I start on the major topics that you were waking up to today. In the studio, we are joined by Abraham MUTHOGO. Abraham, welcome back, man.
Thank you.
It's been a minute.
Yeah, it's been
a minute. It's been a minute. All right, online, we are joined by ARNOLD NGUSALE. ARNOLD, good morning, sir. ARNOLD, can you confirm you can hear us?
Yeah, I can. Good morning to you.
Fantastic. Happy to have you around as well. All right, let's get into that economic review this morning. Now, Kenyans should brace for harder economic times ahead as the Monetary Policy Committee, MPC, predicts higher cost of living in the coming months. Now, with Kenya's overall inflation going up by 6.67% in August. Now, let's talk about the one in September. We are up to 6.9%. All right, on the back of the impact in the rise in international oil prices. CBK is however optimistic that Kenya's inflation will remain within the target range. With a gradual reopening of the economy, CBK insists that Kenya's inflation levels will remain within the target range. Now, leading economic indicators also point to a strong GDP recovery this year, supported by improved performance of the construction, manufacturing, education, real estate, and transport and storage sectors. Other sectors that have grown also include tourism and transport services, and the banking sector that have seen an increase in the private sector credit. While other sectors are on an upward trend, the performance of others remain unpredictable. Let's first listen in to the CBK Governor Patrick Njoroge on that high cost of living before we talk about this morning.
The bottom line here is that we do understand that monetary policy cannot overcome the direct concerns from oil price, supply chain, and weather. So we do understand that. So as policymakers, what we do is we'll look at the second round effects. And those are the ones that we do have control over. In a sense, our policy will be effective in terms of constraining the second round effects that would go through, say, from oil, supply chain, or weather-related factors. So in 2021, our first cut is a growth rate of 6.1%. And in 2022, we expect the growth rate, the economy to grow by 5.6%.
Important what he's saying there. I mean, he's giving us this number, 6.1%. That's exactly where he's putting it at. But then again, you see that briefing was after the MPC policy committee that set it up again at 7%. Fine. But then he's admitting that indeed, when it comes to the Monetary Policy Committee, some of these ones had to be moved by that policy. But even the ones that we expect to be moved, we haven't seen them move, and we're going to talk about it this morning. All right, let's look at exactly where we're coming from in terms of that inflation this morning before we introduce Abraham to the conversation. Yes, we're coming from around 6.56, 6.57. That's in quarter two. But again, if you go back to 2020, we closed in at 5.4%. I believe that's exactly what it is that we're looking at. That's how we closed, 5.4%. But then again, this year, you do expect that because of the coronavirus pandemic and also the high input bill caused by oil, we are going to be at high levels as we close this year as well. All right, let's move into where we're coming from in terms of the economy growth. And if you look at that GDP trend, again, what you're going to see indeed is that we closed 2020 at 0.3%. But if you go back to quarter two of 2020 that we're showing you next, we were at a contraction of 5.7%. So we crossed 2020 in that negative that actually started in quarter two, the impact of the coronavirus pandemic. All right. Let's come back to the studio then. Abraham, now the cost of living is expected to be even higher. That's exactly what they are warning. But then, let's look at the numbers that we're getting this morning from KNBS. They're saying inflation now is at 6.91%. And they're saying this is mainly driven by bad weather, food prices that have rose 10.63%, and they're mentioning something here, the cost of energy in the country now. On average now, we are buying 135 shillings for a litre of petrol, and 115 shillings for diesel, and 110 for kerosene. And they're saying that this is bound to exert more pressure as we go on in the year. And that's what the MPC there, through Governor Patrick Njoroge, is actually admitting. Do we expect that this is going to cross the 7.5 mark, therefore?
Yeah, before I answer that question, if you look at the 6.9% figure,
yes,
it was caused by factors before this latest increase in the cost of fuel.
Yes.
So there's a tendency to match these two. This was prior.
Yes.
If we put it in the time series, this one is prior.
Totally different, isn't it?
So if you're at 6.9 before this major shift, 7.5 is not far off. There's a high likelihood that we'll either just get to 7.5 or we'll cross it. Why? Because imported inflation is very, very difficult to deal with because it is out of your control. They're saying this, the increases are driven by weather, by food. But what is the underlying factor? The underlying factor is the cost of energy. Because now we have increased the cost of gas.
Yes.
We've introduced VAT on it. Kerosene is gone up. Petrol, diesel, and IDO. So all production processes must have an energy component. And most of that energy is either directly or indirectly related to the cost of petroleum.
Yes.
Because you either power it, petrol itself, or IDO, or kerosene, or gas, or you use electricity, some of which was thermally produced. So, what are we saying here? That if we have to deal with the inflation, we have to deal with the driver. Because see, if they're talking about MPC, first of all, MPC has not been very, very effective because the rate has remained constant to a point where people have ignored that tool, for lack of a better word.
Yes.
So unless they come up with very drastic measures, because see now, when inflation starts setting in, certain measures must be put into place. But then again, remember, in any economy, a certain level of inflation is acceptable.
Yes.
Because for economy to grow. So when they give us this figure of 6% growth rate, compared to the inflation rate, unless you're saying the economy will grow because of the increase in prices. I'll give you an example. If today I had mangoes, I had 100 mangoes worth 100 each, I'll be having 10,000 worth of, my value will be 10,000. For me to grow this value, I can only do it in two ways.
Yes.
I either increase the price of these mangoes, or I increase the mangoes. There's no other way. And GDP is that way. So you either increase the production, or you increase the value of things.
Yes.
So yes, when you increase the price, there's an element of showing that the GDP has grown. Because remember, GDP, you can either use the price method, the product method, or the expenditure method. So if you use the price method, price increases would show a GDP increase. So what point am I making? The point I'm making here is inflation is coming from elsewhere. But then again, also in the price of fuel, 46% or thereabout is taxes and levies. So those we're in control of.
Yes.
So to me, if you look at the elasticity of demand of those consumption of those elements, it's very elastic. So if you were to reduce that percentage, the consumption of those products would be by more than the rate of that reduction, thereby giving you a bigger product than you have now. And personally, I think that's where we need to go, because if we go that way, we'll achieve two things. One, we will collect more. Two, we'll start driving down the rate of inflation.
Yes, pretty much. All right, let me bring in Arnold this morning. Arnold, you hear exactly what Abraham's concern is that, well, this latest figures here, the 6.91%, which is the September inflation, is saying, well, remove it from the latest adjustment of fuel prices in the country, which we haven't felt in these figures yet. So, Arnold, with the bad weather again expected to continue in October, do you expect that indeed now we're going to cross that mark, 7.5%?
Okay, thank you so much for this opportunity. I think if you look at the general economics of Kenya in 2021, inflation has been going up. The inflationary rate has been going up, I think, 50 basis points every other month.
Yes.
In January, we were talking about 5%, and then it went to 5.1, and so on and so forth. And we're now at levels of 6%, and we are forecasting 7%, primarily because of several things. You see, with inflation, it's either two things. It's either your currency is losing value, or guys are losing purchasing power, as Gadhogo has alluded to.
Yes.
So we have a situation whereby prices of even normal consumer goods are going up because of the obligation that the country has to two things. If you look at our budget, our national budget, and then we also look at several obligations we have, including credit facilities and other infrastructural projects, it means that the country is looking for cash by raising taxes through various means, which include what you've seen in the energy sector, whereby prices were going up for the government to try to cover some of the deficits that it has. So if you factor in what the CBK governor has covered in the MPC, I think with the MPC, the CBK governor will always try to cover the entire economic spectrum in relation to banking, in relation to circulation of cash and access to credit. And I think what they're forecasting is based on the data which they've been collecting throughout the year. So based on that, I think it's going to go up. But if you look at what the president has tried to do with what Kenya Power is going through with trying to renegotiate the power purchase agreements, I think it's an attempt to try and curb the rising cost of energy, so that in effect that will enable industries like the manufacturing industry and other industries to have to reduce their cost of production,
yes,
which will in turn also affect the consumer goods, basically try to push down the prices. So the government is trying, but I think it's a bit too late to intervene in terms of dealing with inflation. But based on the obligation that the country has, if you look at what the national budget looks like, we're going into an election year next year, and the government financial year just began like 2 months ago.
Yes.
Then inflation is likely to go up. So we're likely to see a rise in consumer goods. If you look at even the fuel prices across the global markets, they've gone up because globally there's been a lot of inoculation against COVID-19. So the economy has opened up. So what we had initially as a glut in oil has turned into a shortage in oil. Therefore, the price per barrel has gone up. When that goes up, those are things which you cannot control, and you may need to adjust your fiscal and monetary policies as a government, maybe give concessions. I saw that there was a fund which has been set up to buffer that. We are yet to see if it will have an effect, but in short term, I think I agree with Gadhogo that we're going to see an increment in the inflation. So I think guys may need to tighten their belts as we go into Q4 of 2020.
Guys need to tighten up their belts as we go on. Let me just confirm whether we have Robert Abujani. Robert, good morning, sir. Can you get us?
Yes, good morning. Loud and clear, Simba.
Fantastic. This is Robert KARUIYI. What am I saying? I thought we had Robert Rucheng. Robert, good morning again.
Yeah, good morning, Simba.
Happy to have you around. I'll be coming to you shortly there for Robert. Let me come back to Abraham. Abraham, the efficacy of the MPC. This is when you like to think now that we'll be looking to them so that we have these monetary policies that can cut across. But then you hear the caveat there from the Central Bank of Kenya Governor Dr. Patrick Njoroge. He's saying, well, some of these causal effects now for this inflation, the MPC policy cannot actually help us, which is the question this morning that I'm asking you. And I asked this question, and Robert, you were here when I was asking that question. I'll be asking that question to you again this morning, because I think that's why I want to jump in. As the MPC, Abraham, lost its sense now in the economy? Let's say for what it is.
You see, you control the economy through two policies.
Yes.
The monetary policy, fiscal policy.
Yes.
Monetary policy, you control the cost of money, interest rates, and you control your forex rates, and by extension, the inflation in the economy, and the cost of credit. The fiscal, you control what you collect and how you spend it. Now, I think we've got into a habit of, we mess up with our fiscal and hope that the MPC will sort out. It has never happened anywhere in the world, it's not going to happen here. So we need to sort out things from where they're coming from.
Yes.
The problem we're having now has to do with, it's a fiscal policy issue, because if 46% of the cost of fuel at the pump is taxes, then maybe we are killing it. So no matter what you do at the policy level, you cannot cure the inflationary effect of that 46%.
Yes.
That you're in control of. You're not in control of the other 54 because it's coming from elsewhere, because that is, it's imported. The price comes fixed, there's nothing you can do about it. So, and that's what I repeat what I said here. Maybe we need to examine because we can calculate the elasticity of all these commodities. And it is true that if you calculate it, that if you lower the taxation rate,
yes,
there'll be a more than compensatory effect in the increase in demand. That is easy to cure. But now, you see now, the inflation we are pushing into the economy, what really can the monetary policy do, given what it is, and given the way we've been static at 7? So again, even if they came up with a very good rate and a very good package, people have sort of moved away from that policy and responding, because there's a question of, do we respond to that rate?
Yes.
The answer is no.
Yes.
So for me, I would look more to the fiscal than to the monetary policy to sort out this.
Pretty much. All right, Robert, that's where you come in as well. And 2 questions for you, and if we could be quick at that this morning. Robert, we spoke about that, and then you say, well, this is a good tool. I mean, it's remained stable. It's kept the rates of borrowing down. But then, Robert, let's look at those numbers. 6.91% inflation rate from the month of September, and we're going into October. Your first question is going to be, in fact, when you're looking at these numbers in the absolute sense, you cannot factor in the recent adjustment of fuel prices in the country. I mean, we've not felt that effect. We're what, 2 weeks into that? And these numbers are popped up now. Good. Number 2, you hear the CBK Central Bank of the CBK Central Bank, the Central Bank of Kenya Governor Dr. Patrick Njoroge saying he doesn't think that the NPC can actually come in and mitigate some of these factors now. Robert, are we going to cross the 7.5 mark? And indeed, do you now agree then that, well, the NPC is becoming useless, for lack of a better word?
Yes, Simba, I see your concern. So in terms of whether the inflation rate will exceed 7.5, so that's quite on the limit of where the central bank would like the inflation rate to be.
Yes.
And we'll wait and see. Yes, we'll wait and see once it reaches the 7% mark, because I believe that's when now the MPC will be forced now to take action. In terms of whether it's lost its use, well, it depends on the factors that causes inflation. The governor highlighted that they have no power against imported inflation. Things like the fuel. We have things like supply chain constraints that are causing these prices to go up, not just in Kenya or in the region, but globally. So these are things that cannot really be contained by the MPC, because what they try to do is just to contain supply and demand. So with them, they can control internal factors. But once it comes to factors such as imported inflation, price of goods imported globally, that is, or maybe the factors that are causing price to go up in terms of maybe lack of supply of certain commodities, or just a breakdown in the supply chain. Yes. So then it becomes really difficult for them to control inflation in that sense. But we'll see how now the NPC tries to juggle, because now they'll be forced to control what they can, that is the internal inflation. So we do expect that in the coming meetings, the NPC will definitely start being raised, because also globally, that's the aim of the central banks, since they believe that this period of inflation was transitory, meaning that it will only be there for a period of time. But now, due to factors such as costs of energy, And of course, the supply chain and a number of commodities actually are in short supply globally. So you might see this period of inflation stay for longer than expected. And this is when now we might see in the coming months, maybe in the coming meetings, because they will reconvene if necessary. So in the coming months, we might see them now take action in terms of increasing the rate just to try and control the inflation.
Pretty much. All right, gentlemen, just quickly on that. Arnold, let me begin with you in a minute or so, if you can. The 6.1% economic growth for this year. Arnold, you and I have been seated here. We got into the coronavirus pandemic. We've seen a lot of figures from the Central Bank of Kenya and the Treasury as well. And I will not be wrong to say, all of them since 2020, since we got into the coronavirus pandemic, the quarterly GDP projections, they have been wrong. And we have to call them out. Arnold, they have been wrong. So this 6.1%, do you believe that it's going to be the figure? Because IMF, I'm actually just put it at 4.5%. In fact, there are some analysts who put it even below that. Is Njoroge being overly optimistic? In a minute or so, if you can, Arnold.
So I think, as alluded to by Robert,
yes,
there's only so much that he can do, and I think he's tried. I think he's tried. If you look at CBR rate, he's been coy on making movements on the same.
Yes.
I think action will be taken in the event things go south. He may reduce it further, just to make access to credit more available.
Yes.
And I think if the figures that we're talking about with IMF are talking about that because of the financing that they've been doing in the country. And because of that, if you look at even the balance of payments and even the credibility of the country in terms of credit ratings,
yes,
it's been going up simply because of IMF. That's why IMF will say what they're saying. But generally speaking, I think...
but Arnold, they have been spot on, though. They have been spot on. They were among the few creditors to the country last year who said we'll close in on a negative. And we did close in on a negative. That
is true. But if you look at it from the MPC point of view,
yes,
I think the governor has really tried in terms of what he can do from an MPC point of view.
Yes,
I think in terms of inflation, the 6% figure, I feel that we will hit the 6% figure because I think what in Q4. I know that government will open up in terms of spending because it's a new financial year for the government. So
yes,
I think in Q4 we'll see a lot of spending by procuring entities, and that will definitely will have a limited trickle-down effect as far as some of these value chains are concerned, like construction of roads and some of the initiatives that the government has.
Yes.
But generally speaking, I feel that we will go to the levels of 6%, unless otherwise.
Here's the thing, though, Arnold. Just Abraham, I'm not supposed to differ with Arnold in this conversation, but from where I'm sitting this morning, I would differ. Here's the thing, Abraham. Since we started 2020, we've been speaking about these numbers that we've seen the Treasury and the CBK throw to us about how the economy is bound to bounce back within the coronavirus pandemic. But all of them have not been spot on. They've been wrong across the board. Here's where we are in 2020. Let me just mention for you some figures. 31 out of 58 actively trading stocks at the NSA, they are trading below their March 19th levels. We haven't gotten back. Lending to the private sector, which we expect will spur the economic growth, at its lowest, 7.5%. We've not gotten above the double-digit figures that we would expect that if they're in the double-digit zone, then the economy is going to be spurred. Yeah. Abraham, do you agree with Arnold that indeed, yes, they've tried, indeed, but this 6.1, overly optimistic?
You see the challenge. You remember last year, everybody was started at 6, they went to 3,
yes,
they went to 1, and eventually they confessed.
Yes.
You know, there's a saying that says that if you torture data long enough, it will confess. Now, but the question is, which data are you torturing?
Yes.
You see, probably we're torturing different data. You know, we're not comparing. Everybody has their own data set, collected in their own way, and and they are torturing it, and it's confessing whatever it's confessing to them. But let's come to the ground. If you stop somebody out on the street there and ask them, is the economy going up, is it going down? Out of 10, 9 will tell you it's going down. And sometimes sometimes there's a limitation of science. We overcomplicate our models to a point where it gives us numbers we don't even know what they mean. Because a 6% in growth rate from a 0.3 negative is quite ambitious. And these are not normal times. I mean, the economy is not fully open. There are so many unknowns, even as we go towards December.
Yes.
So if I was to be asked, I would say, from where I sit now, if I torture my own data,
Yes.
I think it will be positive, but I doubt it will go beyond 3. I doubt, and I can put my money on that.
Quite a good way for us to take a short break. Once we come back, Robert, get ready. Is it 6.1% is going to be the prediction for 3-4? Abraham here this morning. They have not been right. They've not been spot on. ARNOLD, they've not been spot on. Once we come back.